How this man became the worst stock picker of all time. The man, the myth, the legend. Is Sam Bankman-Fried the JP Morgan of this generation? He's certainly shaking up the industry with FTX, causing transaction fees to surge by 50%. Some even jokingly call him the JP Morgan of this generation. Now, let's dive into stock picking and Jim Cramer. You know the typical path to wealth, right? Hard work, saving, avoiding debt, building businesses, and making wise investments. Well, according to Cramer's witty banter, there's another approach. The strategy is simple. Carefully analyze Cramer's stock selections and then do the complete opposite. It's touted as a foolproof method to strike it rich. Why this approach? Well, Cramer has a knack for making inaccurate stock predictions. Despite his reputation as a stock picker and investor, his selections haven't fared well. It's like the reverse of the King Midas story. Instead of everything turning to gold, everything it touches turns to dust. Take the case of Bear Stearns, for instance. When concerns arose about its liquidity, someone asked Cramer if they should be worried and withdraw their money. Cramer assured them that Bear Stearns was fine, advising against moving funds. However, shortly after, Bear Stearns suffered a colossal downfall, with shares plummeting by 90%. JP Morgan and the Fed had to swoop in, bailing out Bear Stearns for a mere $2 per share, a stark contrast to its prior trading value of $80 to $160. These instances, among others, have led investors to conclude that doing the exact opposite of Cramer's recommendations could be a winning strategy. It's a humorous take on his consistent misfires. Birth of the Inverse Cramer. On March 1, 2023, an ETF with a ticker symbol, SJIM, was created with a unique purpose: to provide investment results that are the opposite of what TV personality Jim Cramer recommends. Normally, an ETF goes along on selected stocks based on specific strategies or teams. For example, DFAC goes along on stocks chosen by David Booth and his team at Dimensional, while GEM focuses on emerging market shares picked by the JP Morgan team. However, SJIM takes a different approach by shorting the stocks that Jim Cramer picks. It's worth noting that Jim Cramer has infamously joined a list of investors who have inverse funds based on their positions. In other words, these funds aim to generate profits when Cramer's stock picks perform poorly. This has led to Cramer becoming the subject of ridicule and seen as the antithesis of successful stock picker in the 21st century. To understand how this came about, we have to go back to when Cramer closed his hedge fund and transitioned into media. Yes, you heard it right. He decided to enter the world of media instead of continuing his investing career. This decision has raised eyebrows and left many wondering how it all went so wrong for him. Cramer's hedge fund. So, here's the thing about Jim Cramer and his hedge fund. He used to brag about how his fund, Cramer & Co., supposedly delivered a fantastic 24% average annual return over 15 years, raking it in over $10 million per year. Sounds pretty impressive, right? Well, here's the catch. There's no independent verification to back these claims. Now, let's take a closer look at the stocks that Cramer said he purchased during his time running the fund. You won't believe it, but every single one of them performed poorly. For instance, 724 solutions went from $325 a share to a mere 83 cents. Ariba, once valued at a whopping $40 billion, ended up being acquired for a fraction of that by SAP. And let's not forget about Exodus Communications, which went bankrupt after having a market value of around $32 billion. Ouch! The only stock that didn't completely tank was Verizon, which had its moment of success but also endured a 23-year recovery period. So you have to wonder, if these stocks didn't contribute to Cramer's reported returns, then how on earth did he achieve those impressive numbers he boasted about? Keep in mind that the information we have is based on available accounts, and it's crucial not to treat it as a verified or conclusive evidence of Cramer's investment prowess. Cramer, hedge fund stock manipulation. You know, Jim Cramer, that TV personality we're all familiar with, used to run a hedge fund and claimed to have achieved some impressive returns. But here's the thing. In a recent interview, he made some pretty troubling statements about the tactics hedge funds employ to make money. He straight up admitted to manipulating stock prices by creating activity in the market, even if it meant spreading negative news or taking short positions to make stock appear weaker than they actually were. That's pretty shady, right? It's definitely unethical and potentially illegal. Now, you might think his frankness is somewhat admirable, but it really highlights the unfair advantage that big hedge funds have over individual retail traders. These tactics may work for them with their massive resources and market power, but for regular folks like us, it's a whole different ballgame. So, what can retail traders do in this kind of environment? It's crucial to focus on sound research, keep emotions in check, and not get swayed by rumors and manipulated narratives. Cramer himself mentioned instances where he encouraged spreading false information about companies like Research in Motion and Apple to benefit his own stock positions. That just goes to show how important it is to approach investment decisions with skepticism and conduct independent analysis. Cramer becomes a media personality. Back in 2001, when the technology bubble burst and stocks were plummeting, Jim Cramer decided to leave the hedge fund industry. It was a tough time in the market, but he saw an opportunity to explore a new path in media. In 2005, he joined CNBC as the host of Mad Money, a DIY investment show where he shared his stock picks and investment ideas with a wider audience. Cramer's energetic and confident style quickly made him a standout on Mad Money. He became famous, but also notorious for his stock picks and predictions that often turned out to be unreliable. People started making funny comparisons and memes about his misses. While Cramer's media career brought him fame, it also attracted criticism. His bold statements and dramatic predictions sometimes clashed with the reality of the market, leading to outcomes that were the opposite of what he anticipated. Even when he apologized for incorrect calls, it seemed like his conclusions often went sour. From an outsider's perspective, it can be quite amusing to see Cramer express opinions so confidently, only to see them fall flat in the market. The contrast between his assertiveness and the actual outcomes creates a humorous juxtaposition. This has given rise to internet content that humorously highlights Cramer's investment mishaps. People burnt by Cramer's advice. Unfortunately, Jim Cramer's advice can be a joke for some and a painful experience for others. New investors can be easily convinced by his outspoken and opinionated style, leading them to make risky decisions. One person shared how they invested their entire retirement account into Cathie Wood's ARK innovation based on Cramer's endorsement, only to lose 80% of their money and now face the harsh reality of not being able to retire. While Cramer's entertaining style appeals to those familiar with finance, it can mislead regular individuals. He often forms conclusions based on limited information, disregarding the complex factors that influence a stock performance. Understanding the full picture requires thorough research and analysis, which doesn't fit the format of CNBC's content. Despite many of Cramer's stock picks going wrong, it's worth noting that he has made accurate predictions at times. He correctly called Nvidia's bullish run in 2017 and profited from timely exits and re-entries. He also advised viewers to hold onto Apple, resulting in successful gains. Additionally, he showed foresight in predicting executive changes at Disney. While Cramer has had some correct calls, it's crucial to approach his recommendations cautiously and conduct thorough research before making investment decisions. Jim Cramer summed up. Jim Cramer has made an astonishing number of stock picks, averaging around 3,000 per year, with more than 20 picks per episode. With such a wide range of predictions on various topics, it's inevitable that some will be accurate, while others go completely astray. While it's unlikely that Cramer has ill intentions, it appears that he enjoys the attention and the viewership that his extreme views generate. This highlights a darker aspect of media, where being provocative and entertaining often takes precedence over objective truth. If you find entertainment value in Cramer's style, similar to enjoying Stephen A. Smith's spirited sports commentary, then by all means, watch him talk about stocks. However, if you're investing significant amounts of money that you've accumulated over a lifetime and cannot afford to lose, it may be wise to avoid relying solely on Cramer's advice. Instead, consider sticking to a market index strategy. It's important to be mindful of the potential risks associated with following the recommendations of an entertainer. Lastly, please like and share this video so that we can raise awareness and prevent more people from being negatively impacted by Cramer's advice. Let's appreciate him for the amazing entertainer that he is, while being cautious about making important financial decisions based solely on his opinions.